Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
You see some of these stats, and some of them stick out because they're so unbelievable is the wrong word, but if you were to poll people, I love my polls, I feel like everyone would get it wrong. Can you tell us about your bond chart?
Sure. This kind of goes back to even broader asset allocation with our firm. It's the view that if you can allocate kind of away from fixed income and more to equity but have similar risk, then you're probably better off. And the reason for that is in the chart, as it showed, a lot of people look at bond returns, bond yields, and say, hey, it might not maybe compensate for the risk taking, or better said, may not allow me to get where I need to be from a financial goal perspective. But it's usually viewed pre-inflation and almost always viewed pre-tax. And so if you look at bond returns long-term, so 100 years after inflation, after tax, you're looking at it roughly 0% total return. And I think that's something that would surprise a lot of investors. And if you can move away from that to something that can provide you positive after-tax real return, then you're probably better off as an investor.
I mean, let that sink in. A century of no returns. And forget about if you're an advisor where you lop on another 50, 100 basis points on top of that, those bonds. So my Morgan Stanley advisors that are listening to this, and you're an end client, and you're like, after inflation, after tax, after your fees, I'm probably losing money on this investment, or I have for the last 100 years. That's sort of a crazy takeaway. And then you look at it, so we'll put the link on YouTube and in the show notes, but it's a chart of the S&P, how much it's done over the past 100 years versus bonds.
Yeah, and even if you get to today, I mean, you think, let's say starting point 5%. Let's go there. If you think inflation, let's say it's 3, then you're looking at 2% real. And the big challenge with fixed income is you're not taxed long-term on your gains. You're taxed every single year on the yield at the short-term rate. So you're looking at a 33% or higher. We live in California, so call it 50% at the highest rate on the 5%, not on the 2% real. And so you quickly get to, even at current yield levels of 5%, which people are saying, finally, there's yield again in bonds, you're still looking at maybe a 0% real after-tax return.
And on top of this, and I've been kind of preaching this for a while, but looking at a lot of the even riskier bonds. So you look at some of these other ones, like you're not getting compensated with a whole heck of a lot of yield relative to probably the risk you're taking. Because like if you think in your head, corporates or junk or 30-year, a lot more volatile than T-bills. And then you add on all these other considerations and it's, I don't know, man. Doesn't get me all hot and bothered. Better than zero, I guess.
No, we could talk high yield as well, but we've done analysis on that too. High yield historically has returned about 2.5-3% less than its starting yield, going back about 30, 40 years. The reason being, at the most you can do with bonds is capture the yield. When there are defaults, you start getting into trouble, you're going to capture less than the yield longer term. It varies. Sometimes if yields compress, all that stuff. But again, if you have a starting point where yields are very tight, like they are in high yield right now, you're not getting that much more incremental return from high yield compared to history. And so it's a real big challenge for investors going forward for sure.
Yeah, but everyone keeps hoovering them up, particularly the liability driven, maybe people that say, hey, man, I can lock in this 5-6%. And they do, but it doesn't create the opportunity, at least for them to be the normal spreads. Anyway, we'll see. Who knows what happens?
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.